All right, folks, welcome back. This lesson, I'm going to talk about the idea of multiple setups inside of the trading sessions. So there's a morning session and there's a PM session when you're working with the New York index futures. If you look at the market in terms of a split day, the New York lunch hour between noon and 1 o'clock PM, New York local time, 8:30 in the morning to noon, that's essentially the morning session. There can be multiple setups inside of that. If we're looking at the S&P futures mini contract for June 2022, you can see we recently traded up above the relative equal highs. So buy stops and buy side liquidity were resting right above here. So as the market drove above that, we always have the likelihood of seeing it continue going higher. But whenever it goes above relative equal highs and then we get a swing high like this, as soon as this candle closes the next day, I'm looking for something to create an opportunity to go short. So we could be anticipating an open here, rally, power three, the accumulation, manipulation, distribution, and then incorporating the next level of analysis, which is understanding whether we're going to be in a premium or discount market. Now, obviously, we're in a premium market. We're above old highs here. We really stretched out on the upside. From this high, if we start to go lower, this down close candle is your bullish order block. The idea of it trading into that down close candle once it goes above these highs, that's favorable. That's something that could potentially happen. So the market does in fact trade down into this down closed candle. That is your bullish order block. But I want to go inside this particular day here, which is obviously Friday. And we're looking at the internals behind what it is I'm trying to teach you and how you can find multiple setups inside of each respective session, the morning session and the PM session. All right, so here is the hourly chart on the S&P futures mini contract for June 2022. And I kind of want to bring your mindset back into what we're looking for. And that is the power three. We're looking for an expansion move, direction higher or lower. In this case, we're looking for it to go lower because we have the daily bullish order block level, that line here. And look at the lay of the land. Okay, what is it that we see also in the price action? Well, if we go over to the left, you can see we have relative equal lows. We have this low and we have this low here. So they're relatively equal. Not exactly. That's why I named them relatively equal lows. The idea of liquidity resting below here by itself without the order block is likely, but it's further likely if we have a discount array, which is that bullish order block on the daily chart. So we have multiple factors here leading to the likelihood of this area being probed for the purpose of pairing liquidity, the sell stops basically being rated. Initially in the morning, we were seeing the market trade higher, 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 higher. And then we broke lower, attacking the sell side liquidity here, and then aggressively running into the daily bullish order block. I want you to take a look at this framework from this high down to this low, and this being a fulcrum point, that being if this high trades to this low and we break this low, how far can we go down? I'm going to touch on that in the next slide. But for right now, I want you to think about how the opening price, what's the opening price? Well, there's two. If you're trading index futures, the opening price is midnight at New York time, and that's this candle here, and that's the opening price. And then there's another opening price at 8:30 in the morning. The opening price in the candle that begins 8:30. So if you're bearish, ideally you want to see the market trade above that opening price. This is going to be manipulation. Okay? The manipulation is the running above a key level when we are bearish. We're expecting this to go lower. All of this is basically market protraction where it's a Judas swing. Okay, the market's going in the opposing direction that it's likely to go to later in the day. So later in the day, we expect this to go lower. Where's it going to go? Below this low. If it accelerates below this low, where could it go? Below here. Okay, then we have the bullish order block on the daily chart. So we have a lot of things coming together that draw on a great deal of probabilities. Now, probabilities are not absolute guarantees. Okay, that's not the case in trading. If that was the case, I would never take a losing trade. You would never take a losing trade. We wouldn't need use stop losses, and it'd be great. But unfortunately, we have to contend with risk. That being the case, we have to at least build the idea around the likelihood of a scenario unfolding, but being prepared if it doesn't. So if this market is opening here at midnight and it starts to rally, we can anticipate this selling off. But if it can sell off from here and trade below this low, how much further can it go below these relative equal lows? Obviously, we have the daily bullish order block level here. So we drop down into that level. And look at the reaction here. It's nice, isn't it? So going below this low, that's the initial target, then reaching below the relative equal lows over here because that's where sell side liquidity is going to be residing, then tapping into that bullish order block on the daily chart. But how much further can we go below that level? How far beyond the actual order block level can we go? Well, I'm going to zoom in on a 15-minute time frame. This is what you're looking for when you're doing your analysis. When everything starts to show a willingness to want to go lower, how do we know it's going to go lower? Well, we have the swing low here, decisively broken. See that? This low, broken hard. Then we trade back up into the imbalance here. So the fair value gap, we trade up into it here. At this point, we anticipate the candles past this, or the new forming candles, to trade lower and trade below this low. And if it does go below this low, we're looking at this price point here, that low, as a fulcrum point. That being measuring this high down to that low, that same measurement of distance, and we expect that projected lower. Okay, so this is my swing trading model, and I'm applying it to targeting. So the way you do it is you take your Fibonacci and you anchor it to the highest body. It could be an open or a close, it doesn't make a difference, but you anchor it on that. Notice I'm not putting it on the high here, and I'm doing the same thing with the lowest open or close in this swing low. This retracement up, I'm measuring the distance in terms of range with the bodies of the candles. By having a measurement from the highest body in this swing up, in this swing low, the lowest body, that means the lowest open or close, okay? I'm anchoring the fib on that. So below this low, we're looking for it to run into sell side. So if it goes below this low and aggressively expands lower, this could be your next target. 45.14.5. If it goes below this one, we can anticipate it trading down to what? 45.01 Now, the question you're going to probably have in your mind is okay, this is all fine and great, but how do we know which one to pick, ICT? If we look at the idea that 45.04 is just below what level? That daily bullish order block at 45.04. Well, at 45.04, and we're getting a measurement down here, that means we could see it trade down to that level here. Now, if you look up here at this level right there, that low is exactly the candle's low right there. That is your daily low. Look at the reaction there. Now, the order block level is just right here, but it stabs down into what the algorithm is going to measure. So there's the order block. It wants to go down to it anyway. There's relative equal lows. It knows there's liquidity down there. And you have the measurement. So the precision element is only going to be beneficial if you have all the other narrative incorporated with your analysis. That being the market's likely to go lower because we ran out those relative equal highs on the daily chart. We created this swing high. We broke lower aggressively. We're likely to trade into that daily bullish order block. Then we have this retracement here. It completely closes in all the imbalance that's between this low and this high of that candle. It rebalanced all that, and then we roll over it. Here's that gap I mentioned. Trades up into that. We anticipate what? The candles after this candle closes. We want to see acceleration to the downside. We get it. The market starts working lower, lower, and finally, right on a dime, that candle is that low. You will not get that measurement if you use this swing high and that swing low. All right, so taking this a little bit further, now we're into a 15-minute time frame. The opening price, again, is this candle here, which is midnight, New York time. The opening price, that candle, you extend that out in time. So if you know that the likelihood of price wanting to draw down to this daily bullish order block, and we have that level of 45.01, which is that candle's low, we don't need to have that yet. But we know that this is going to be a draw on liquidity because it's also below those relative equal lows that I mentioned when we were looking at the higher time frame chart. So all of this here is a build up into a premium. The market then breaks aggressively. What did it create here? What happened here? We had a displacement down. Did that take out that swing low? Yes. Does it trade up into that imbalance right here? Yes. Does it trade above the opening price? Yes. How many boxes did we just check off there? A whole lot. Probabilities are now going through the roof that this is bearish. Then the market breaks lower, trades down to the old swing low, sell side liquidity resting below there. Watch what happens. We trade down through it, and then we aggressively rebalance all of this down move. We come right back up into it, bearish order block, then sells off another wave into this short-term low, deeper below this low, and eventually, into the lunch hour and past it for the daily bullish order block. Now, when you look at this type of price action, you might not see that as an entry, but it is taught to you in this mentorship on YouTube. But what other setups are here? All right, so here's the opening price again on a 5-minute chart. Here's the 15-minute time frame fair value gap, and the market trades right back up into it above the opening price. That's what it would look like on a 5-minute chart. Notice it does not look clean like it does on the 15-minute time frame. Let's go back up one more time. See the gap here? And that run right there at 9:30, that coupled with this time frame, you probably wouldn't see that as a sell. You would want to see this filled in, but you got to look at the higher time frame. The higher time frame, 15-minute time frame, is providing you the framework. It's giving you context that, okay, this is all we need. We don't need it to trade up into that. It could, but we don't need it to. So when it trades up there, then it starts to break down, it rebalances, breaks down again, works into that short-term low, sells off again, retracement, sells off again. In here, this is your entry at the opening. So in the morning session, you typically have 2 to 3 setups because you have volatility coming in at the opening being 9:30 New York local time. That can be very tricky. If you're not really sure what you're doing, you can get caught up in the initial volatility and offside real quick, and it can run against you aggressively and hurt you. I prefer to see my students look for the initial move to kind of like qualify what you're expected. Lower prices, right? So does it give it here? Yes, it does. So how can you participate in something like that and still have the bias behind you and have multiple setups that you can take? Well, let's take a closer look on the lower time frame. Here's the 1 minute chart. Here's that return back up into the fair value gap on the 15-minute time frame, and wasn't so clear with the 5 minute. But now look what we have here. Small little imbalance there, that fair value gap right above a short-term high. We trade up into that there on a 1 minute chart. You would see that as a setup for the 1 minute chart. Before I go any further, I want you to pause the video and go through this price action and find the setups that you would see as a shorting opportunity if your bias was in line with what I'm suggesting here, as it should have been, being bearish. All right, so the first fair value gap here, right there, because we have this short-term low broken with the run lower. So there's displacement there, obvious displacement, very energetic. And we have this candle's high, this candle's low, the market returns back up into it. You can go short there and look for what's the first objective, that fulcrum point, that short-term low. Aim for the liquidity, so your target would be there. Next one is here, another short-term low taken, fair value gap there. We trade back up into it, that's a short. You can go short here, and again, same premise, looking for the first run below here. Another one is here. We have the imbalance here after we aggressively moved lower and then retraced back up in. This was a shallow run below that old low, so we anticipate it to run a little bit deeper, and it does. Okay, so you can take profits below this low here as a partial. And then you've seen now, obviously, multiple opportunities within the same morning session. So it's also showing you how, if you miss your entry, how can you get back in line with the marketplace and still participate in these moves. Now, there are going to be days where we don't have this many retracements back and back and back and then goes lower. It'll be just one or two and it just keeps on going. Or many times it'll be just right at the opening and that's it. You missed it. It just goes right to where you thought it was going to go for the day. And you can't get mad about that. You should be happy that your analysis concepts are speaking to you with that much clarity. And just know that because they repeat, none of you should be upset that you missed a trade. Now, you're probably looking at that pink rectangle asking yourself, what the heck is that? Well, that is the PM session buy side liquidity pool. What does that mean? This high here was the most energetic one in the morning session. It took us all the way down to what target we were looking for, the daily bullish order block. Because it's Friday, because it hit the daily time frame objective, it's in a discount market, it's really traded lower. End of week, there's going to be a retracement back into the weekly range. What can it aim for? Well, it can aim for the liquidity resting right here because it's going to likely pull back up into a premium. What does that mean? Here's 8:30. Here's the turning point at the 9:30 rotation. So this high down to our target. If you put a Fibonacci on this low to high and find the 50% level, this is above 50%. So that means above here, that's a premium. So the market's going to move from what? A discount to a premium. That's what the market does. That's the algorithm does. It seeks discount to premium, premium to discount. Within that logic, the market is reaching for liquidity in the form of buy stops and sell stops, and or imbalances, or the creation of an imbalance, fair value gaps, or returning back to a fair value gap. Okay, that's all these algorithms do, and they do it on the basis of time, then price. So we have a PM session buy side liquidity pool that the market could likely reach up into, and there's going to be short covering. Who's short covering? The smart money that sold short here, 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 and here. So if they're covering a short, are they bearish still? No. So if they're not bearish, what are they? Bullish. So if they're going to be smart money and buy down here, or if they're going to use this imbalance in here, if it trades down into that, you can see a run higher. If they're going to buy it, what are they going to target? The buy stops up here. And they're going to sell right to those buy stops. They're buying this and selling it to these waiting buyers on their buy stops. Notice these relative equal lows. They take it into the order block right below those relative equal lows because it sells what? It sells the retail crowd that this was support broken. What are they going to want to do? When it trades back up into these relative equal lows, they're going to do what? Sell, right? That creates more liquidity for buying. So this is engineering buy side liquidity on the basis of sell side flow. Sellers coming in the marketplace. These sellers, they're going to have a counterparty in the form of smart money buying it. They want to sell short because they see relative equal lows breaking. The trend's been down. Everything looks bearish to them because it's been going down all day long. So they think naturally it's going to keep going down when it's only traded down to where the algorithm says this is what we wanted. And now we're going to reprice higher. We're going to move from a discount to a premium. The premium intraday is going to be this area here. And that's going to be where the market draws to for the afternoon session buy side liquidity. All right. So we have a mitigation block here. And I teach that in the YouTube channel. But we have market structure breaking. We come back down into the mitigation block. And we also have the imbalance, fair value gap there. So we can be a buyer here And remember the 45.32 to 45.40 level, we trade up into it here. So buying here and aiming for that liquidity up here, that would be your target from buying to getting out there, selling to those waiting buy stops. The next one is here. The market trades down in. Then we have the run up into that area. So it's not a bad little run. Now, once we get up into that shaded pink area, what have we done? We fulfilled buy side liquidity in this area here, but we have a little bit more later on, which obviously you can see it runs to, but here we see it do a run lower. So we break below a swing low, market structure shifts. Is there any imbalances in here? No, but there is one right there. See that? Here's your fair value gap, shift in market structure there, retraces back up into the fair value gap. You can be a seller there and aim for this low, or you can wait for a confirmation entry, which is we turn here after it hits that fair value gap, breaks lower, and then we have another break in the structure of the marketplace on the 1 minute chart, creates the imbalance here, fair value gap, trades up. Yes, it overshoots it, but we also have two fair value gaps. Remember the rules I gave you? If you have a fair value gap and a small one right above it, anticipate it likely trading up into you, but use this as your entry. Go short here and then aim for the order block. So if you have an understanding of how we're going to work within the intraday volatility, using liquidity, using the time of day, using the day of week, all these things come together and they make a really beautiful tapestry so you can read price action.